All right, I think we're on Double A from Macro to Mortgage, who is our stock cheat sheets macro analyst. We get together at the beginning of every week and dissect global M2 and interest rates and what else?
The dollar and gold and
All that stuff to figure
equity.
out how badly we're going to get torpedoed by all of the deficit spending we're doing.
Yeah, yeah.
But the purpose of today's video, and we're going to create this as an evergreen tutorial video to help explain something new that we've started here at Stock Cheat Sheets. This is a premium feature. It's free at the time of recording this video because this is still a work in progress. I'm still testing it. And then we'll lock it down as a premium feature. As you know, we use Tailwind Score and Relative Strength Analysis as our two primary tools for analyzing ETFs to figure out, where the strength of the market is. But I needed a more robust tool for stock analysis. And that's what this is. We're calling it Ticker Tiers. And Ticker Tiers springs from the ticker totals that are a rolled up score of 11 different factors that we then model and put them into four quartiles. So we have level one, which is the top tier. Level two, which is the probably the most important tier because it's bullish without being overbought. And then we have level three and level four, which are slightly bearish and bearish. So the more stocks you have that are in level two to start, that go to level one, the better you're going to be. And we're going to model probably on a pretty consistent basis the NASDAQ 100. So Double A, I brought you in as someone who's never seen this report.
Yeah.
So that I can, as I explain what we're doing, you can ask questions.
Excellent. I'm looking forward to it.
So this is a model of 100. I think there's actually 101 stocks in the Qs right now, and that's what this is. It's the 100 holdings in the QQQ ETF.
Okay.
And so I'm going to start. We'll start big picture and then roll down into the factors. We'll try not to get too deep into the weeds because I don't want to lose too many folks. But what's most important is this is once again a stack rank. So we take as many different factors as possible, creating a unique analytical formula for each of the 11 factors. And then we roll those up into sort of one big formula that determines what I like to call the weighted composite. So imagine a point system where the more strength you have in a particular area, the more points you get. And then you have different categories of points. And then it's like having the 5 judges at the Olympics, right? You drop the low score and the high score, you aggregate the rest and create a composite number. And that's what this is over here on the left-hand side. The absolute number really doesn't matter that much because many of these variables, they're not graded on a 0 to 100 scale. They're graded based on standard deviation and mean score. So the gross number itself doesn't matter, but then the percentile rank is a way of measuring the strength or weakness of each of the individual tickers relative to one another. So another way of putting this is that Datadog here, DOG is the ticker. It has a weighted total score of 22, which is kind of meaningless. But what this tells you, Double A, is that it's better than 92.2% of all the other stocks in the stack rank. Another way of saying it's in the top 9.8%.
Got it.
And so that would put it into the top quartile, level one. And the quartiles are done not basically 0 to 25, 25 to 50, 50 to 75, 75 to 100. It's done on a bell curve based on standard deviation. So you're going to have more stocks clumped in the middle and fewer on the extreme end. So think about long tails.
Yep.
And so that's the idea behind this. It's a more of a statistical approach. And I think that's an upgrade over the cheat sheet ETF model, which is more rigid in terms of the point system is based on a 0 to 100 score for a bunch of different variables. So still useful for ETFs, but when you're dealing with stocks, there's nuanced differences between all of them, and you need a more robust system. And that's why I decided to do this for stocks.
That's really cool. I like the fact that it's a bell curve and basically that you're doing it on standard deviations, which aren't static, but rather move.
They move, right?
Yeah,
You're graded
exactly.
on a curve based on how the rest of the class does.
Love it. I love it.
And so what I'm going to try to do in my report, and actually for those of you who subscribes at cheatsheets.substack.com, you'll see this in the blog as of the first week in July when I'm recording this, that we actually go into the distribution and we show you how many are level 1, how many are level 2, 3, and 4. And we also give you some other interesting things like what's the money flow distribution or what's the RSI distribution. So the nice thing about having this expanded set of data variables that I'm going to walk you through now is that we're able to do more analysis on these 100 stocks because everybody's got a different time frame or places a different emphasis on metrics than even I do. So we cater to those who are round tripping on stocks within the course of less than a year. So we're an intermediate time frame data service. And I can show you there are 100 stocks in here. I'm going to stick with the stuff at the very top just to start with. And so for that reason, I've geared the model toward those who are selecting stocks who have weeks to months of trend following patience. So this is not for long-term investors. This is not necessarily for swing or day traders, but the fact is that since I'm sharing this data in a manipulable spreadsheet, you'd be able to organize the data that's most important to you and stack rank this stuff differently. So if all you care about is stocks that are in an intermediate bullish uptrend, but in a bearish short-term pullback, you'd be able to stack this stuff and just look at those two variables and have it advise your own trading strategy.
So you're delivering it with a very specific time frame in mind, that trend trading, right? That intermediate trend,
Yep.
But yet people will have the ability to come in here and manipulate this data to help them find whatever time frame it is that they're looking for.
Yep. There's 11 factors. And so the one thing that we don't do is we don't give you the way we quant each of these factors because that is our secret sauce or how we model for our particular time frame. So for example, the one thing that's proprietary about this is none of the technical metrics are all that secret, but it's the way we combine them for our specific time frame, which is intermediate trend following. Think of that green line in the market forecast for those of you who follow macro to mortgage, the 5 easy charts, or have been following me on cheat sheets, where we talk about the intermediate time frame. That green line is part of the Thinkorswim oscillator series that it basically extrapolates momentum to predict future trend.
Got it. Okay. Yeah.
So let's get into it. So these are the composite figures. You go to your right, and you'll on Cheat Sheets blog, when I send this out to people's email, we'll usually give them a teaser data set right in the blog with then a link to go to a spreadsheet that's not unlike this, where they can sort the columns how they want.
And so these are the 11 components that you mentioned.
They are, and this is what's important to me as a intermediate time frame trader.
Okay.
So again, all of the data is going to be based on a scoring system that will produce an array of different outcomes. Some of them will be, yes, no outcomes. Others will be on a 0 to 100 scale, but most are on a more of an arbitrary scale where we're using standard deviation and mean scoring to get at that. But we have different buckets that we aggregate then and weight accordingly. So the first bucket, which is definitely based on a matrix of data outcomes, we use the RSMK relative strength metric, which is basically comparing these stocks to one another and to the broad-based index. And so you have, so for each of 3 time frames, 30 days, 90 days, and these are trading days, not calendar days. So when we say 30 days, we're really thinking about 6 trading weeks, if that makes sense.
Yeah.
That would be in column C here, our short-term trend, about 6 weeks, 30 days. And that might be a long-term time frame for a swing trader. So again, it all depends. 90 days is, again, when you divide by 5 calendar days, that's more like 14, 16 weeks, something like that, about 4 months. Mm-hmm. I think it's 4 months. Is that right? 90 days?
Yeah.
Yeah, I think it's 16, 18 days, 18 weeks.
18, yeah. Okay.
Yep. And then 180 days, about 6 months.
Yeah.
And then it will give you either significantly underperforming. Uh, we don't have a performing at the market, right? You either are a little bit over or a little bit under, or you're a lot over, you're a lot under.
Okay.
So you have basically 4 quadrants of relative strength scores. Again, we plot these, take the mean score, and then use distance from the mean and then cluster them together. So the ones that are in the middle would be outperforming slightly or slightly underperforming, and the ones more at the extreme level are significantly outperforming or significantly underperforming. So then we take those 3 time frames and we quant up each of those time frames into a kind of a macro relative strength score, where we weight the 30 and 90s a little bit more than the 180s, just because that's my time frame. But again, you would have the ability to sort this data however you want and find the stocks with the greatest money flow that are outperforming at both 90 and 180 days if you wanted to.
Right.
So relative strength is the first kind of bucket here.
Okay.
First 3 factors. Next up, and these are yes/no buckets, so these I won't spend too much time on. And those of you who've been subscribing to cheat sheets for a while are very familiar with these. We use these in our relative strength rank and trend report. For our short-term time frame, if the 5 is above the 20-day moving average, we call that a bullish configuration. Short-term trend is, listen, price might be going sideways, but in terms of the moving averages, we're not bearish, we're bullish.
And the daily moving averages?
Daily, correct. 5 versus 20-day EMA. And these are exponential moving averages, so slightly, they favor the front half of the averages or the data set compared to the back half. So it gives a little bit more weight to the more recent data.
Yep.
And then we have the intermediate trend, which is, again, the 10-day moving average, exponential moving average. Above the 40, it's bullish, otherwise bearish. And the long-term trend is the 10 EMA over the 40 EMA. So slightly faster than the 50-day simple moving average and the 200-day simple moving average. This would be as close to that, but it's slightly steroided up.
Yeah, so that's a weekly is what it says, right? So that's the
weekly.
10 week over the 40 week.
Yeah. So you have 5 versus 20-day, 10 versus 40-day, 10 versus 40 week.
Got it. Okay.
Bullish or bearish. Okay, so these are yes/no variables. We then have money flow or buying pressure. I use those interchangeably. They speak to institutional accumulation. This is the Chaikin money flow score. This would be the spot money flow score, which is a 20-day look back. So the last month or so, four trading weeks. And there are 5 possible outcomes here. And those of you who followed my relative strength reports know them very well. There's very bullish. Actually, you know what? I added a little zhuzh to this. We have very bullish, very bearish, bullish, bearish, neutral, and then we have 2 other metrics. Let's see if I can find them here. Here we go. A money flow score of less than negative 0.3. I don't just call it very bearish, I call it panic. So severe institutional distribution. So if a money flow is below negative 0.3, I call that panic selling.
Okay.
And then if you're above a 0.3 Chaikin money flow, let's see if I can find one.
I have a feeling I know what you labeled this.
I think you probably do. Let's see if I can find one. There was, I think, one. There it is. FOMO.
FOMO. Yeah.
So very bullish is above 0.2, but below 0.3. FOMO is above 0.3, 0.1 to 0.2, which is still very bullish. I mean, it's bullish.
Yeah. Still
a very good rating. And then anything between negative 0.1 and 0.1 is, I just put neutral. Okay. So again, FOMO is a really serious metric. And I think that if you combine that with a relative strength trend, and you're really trying to anticipate a trend that's unfolding rather than one that's close to happening, those might be the 2 metrics that I would look at.
So correct me if I'm wrong, but if I'm looking at this and I'm looking for something, if I'm looking to take a little more risk and whatever, I'm looking for something with FOMO that maybe hasn't, the 10-40 week maybe hasn't crossed yet.
Yeah, and of course we're several weeks into a major bullish trend, so you're not going to find that.
Right, right, right.
But yeah, that's the idea, and that's the nice thing is that any investor can basically take a look at the metrics that matter to them the most, or just follow my very statistically related ticker total scores. So I try to take the arbitrary point assignment work that I did for the first round of cheat sheets, which I think are fine for ETFs, right? If you're very bullish with an uptrend and money flow above 0.2 and this, that, and the other thing, then you're going to get a very high tailwind score. And the opposite would be the case if you're very bearish. But for this, I think there's a lot of nuances with stocks. And I wanted to give the subscriber more flexibility in either using my kind of modeled scores or to take the variables that matter to them the most.
I think that's great.
So here's something new that we haven't had on cheat sheets before. I call this persistency. And so what we're doing is measuring Chaikin money flow in a few different time frames. So we use the Chaikin money flow, what I like to call the at the market money flow, which is the standard setting, which is CMF 20-day look back, right? It's about a month.
Okay.
And again, if we're above 0.1, we're bullish. If we're above 0.2, we're very bullish. Above 0.3, we're FOMO. And we would have a parallel set of metrics for bearish side. And so if only the Chaikin money flow 20 was showing those numbers, but no other time frames were reflecting a similar, we would have a, let's see if I can find it here, a Chaikin money flow 1 month accumulation, meaning you've got really bullish or very bullish or better. I don't make a distinction here because we do that here, right? The spot money flow is bullish, and it's been that way for about a month.
Okay.
So if you have 3 months, meaning your Chaikin money flow at the spot, and I think we use the 40-day look back. So last 8 weeks, we call that 3 month accumulation. It's 40 trading days, which is roughly 8 weeks. I guess it's more like 2 months. So that's probably a little stretch on my part. And then 6 month accumulation would be at 21 weeks. So 21 week look back. And so you'd have to have the money flow positive for each of those 3 measurement periods in order to achieve 6 month accumulation. You'd have to have money flow bullish or better for not only the spot Chaikin money flow, but again, the one that looks back, I think it's 45 days. If that makes sense.
Yes. Yes.
And if you don't have a money flow score that's bullish or better in any of those time frames, or it's very bearish, I call it minimal. Minimal could be negligible, but I just use the word minimal, meaning there's no real institutional accumulation happening.
So minimal can include no accumulation, but also distribution.
Yep. And I didn't measure distribution because this is a bullish end of day trading system.
Sure.
So this is not, you could use some of these metrics to go short. I had to keep the model simple. And so I didn't get into, I figure very bearish and minimal means that if you have panic and minimal, it means you have not only are institutions selling, it really doesn't matter if they had been buying before. They're dumping stock.
Right. That's fair. Yeah.
All right. So that's kind of a twist here. I think, Mark Chaikin, back when we were repping Chaikin Analytics, used to talk about the importance of measuring persistent buying pressure. And I thought that was important to add to this model.
I agree with that. I appreciate it a lot.
All right. Now, the next one is more of a timing indicator. And so you may disagree with a couple of my ratings here, but I think it gets to where I want to go because what I care about is where we're optimally bullish from a timing standpoint. So this is the RSI indicator. Mm-hmm. And it's the same one that you shared with us on your recent macro to mortgage, macro Monday. What are you going to call that? Not macro Monday. 5 charts, right?
5 charts. Yep.
I like that. And anyway, you can catch 5 charts very soon, starting in July on stockcheatsheets.com, as well as AA's macro to mortgage site.
Yeah.
So the RSI, we're showing you the level and the direction. And for a lot of traders, that's all you need, right? You're off to the races, and then you can, obviously this is a starting point for your own research. But this tells you instantly, for example, if you're at 67.94 and falling, it's likely that you understand that that means that the RSI has, and by the way, I don't explain this here, but I measure the falling with a 3-day lag. So it's a little bit less sensitive than if it was a 1-day look back.
Okay.
So the RSI is falling, meaning it's lower than it was 3 trading days ago.
Okay.
Okay. So 67.94 and falling would be the equivalent of a neutral minus score in my mind, meaning it's reversed, but at a high point, but it's falling. Whereas 76.24, a lot of people would think of that as overbought, but as long as it's still rising, I don't hang it with baggage.
Right.
So as long as it's above 70 and still rising, we're okay. 69.94 and rising, we're okay. 66 and rising. See, the optimally bullish is going to be between 50 and 70. So above 50 and rising. And actually, this column defines what this means. So I should go back. So at 67.94 and falling, it means that we are neutral, mixed, meaning the oscillator is rolled over.
Right.
So it's still in bullish territory, right? We haven't crashed below 30, but this is where I would sell covered calls.
Right. I was add and to your point about, this is a great place to start your research, because if the RSI is 67 and falling, I want to go put my eyeballs on that and see,
right,
did it fail to break 70, or is it falling out of 70? Because
that's right.
Those tell me two different things.
Yep. And so there's a limit to what the data can tell you. You got to go look at the chart, but this would immediately draw your eye to Datadog, where, hey, I might be long a naked call on this one. I might be very profitable, and I might think that there's still room for this to go higher, but it looks like it might roll over in the short term. This might be a good place to sell a covered call. Yep.
Cool.
Or a leg into what would essentially be an in the money diagonal if you're a more advanced option trader.
Right. Yeah.
So anything that's 50 and rising, bullish momentum. So again, some might argue that above 70, the RSI is overbought and we shouldn't call it bullish momentum, but I would disagree. I think the RSI can stay overbought for quite some time and price can go up a lot. So as long as it's rising and above 50, bullish momentum.
100% agree with that.
Yep. However, once you're above 70 and rolling over, overbought with pullback potential, right? Pullback is when you cross below 70.
Yeah. Okay.
And so we go on and on like that. And for those of you not familiar with the RSI, you should study up on it. You're not going to get that out of this video. And for those of you who are familiar with the RSI, I think you get it at this point.
Yeah.
So here we've got 57.6 and falling. We're getting mixed signals. So we're below 70 now. So it's more bearish, and we're falling. So I'm calling this mixed signals.
Okay.
And then I don't think there's too much bearish here because the NASDAQ has just been on a tear.
Yeah.
And this is one thing to just look at and say, the worst thing we have is some stuff is overbought and moving lower. But okay, that we get T-Mobile, bearish momentum. That means it's crossed below 50 and it's heading lower.
Okay. And what does one column to the right stay there on T-Mobile? I'm just curious what that looks like. Column to the left. I'm sorry, the left. The other 49 and falling. Okay.
Yep. So just barely. And that might be one, well, it just crossed below 50. It's got bearish momentum. I'm going to watch that one closely, whether my trigger is 40 and lower or 30 and lower. This gives you an idea of whether or not to buy a put.
Yeah.
Okay. So this is something new since version 1.0. I thought it important to add another forward indicator. So the RSI gives you kind of a current snapshot of momentum. Think of the intermediate trend forecast as a second derivative, maybe a first derivative of the RSI. It is basically a momentum oscillator that extrapolates, but in a very specific time frame. That would be the one that I care about. You obviously do too, because you put it on your charts. Mm-hmm. This would be the intermediate market forecast indicator, which is available on Thinkorswim's platform.
Right.
And again, if you're above 80, going in any direction, you are overbought. You're going to find a lot of the NASDAQ at the time we're recording this because we've been up since April 7th, right? And it's July 4th.
Yeah.
So this has been a screaming bull rally. Some of you may, be in the time capsule 3 months from now going, God, those were the good old days, right?
It's possible.
And you'll see extremely overbought is when that green line is above 80. Mildly bearish with some reversal risk. That means we're in that 50 to 80. So we're in the upper half of the oscillator, but the green line is rolled over and is pointing lower, or it's fallen below 80 and is pointing lower.
Okay.
So that's mildly bearish. And then we have different takes on that same oscillator depending upon where it is, from extremely bullish overbought to extremely bearish oversold. So here's mildly bearish with some reversal risk. So what this means is you are, this is where you're falling out of the upper reversal zone. For example, the lower reversal zone and heading higher. That's what this means. So I use the football analogy a lot here. If you're familiar with the Thinkorswim Market Forecast Intermediate Oscillator, when it's in that lower reversal zone, it's about as bearish as things get. But oftentimes, reversal clusters can form on the market forecast tool. And when it turtle heads just above the 20 line, it's, that's not true. I'm sorry. That would be mildly bullish with some reversal risk. So this would be the opposite of this. This would be falling just below 80.
Just below 80. Okay.
And pointing lower. So you're mildly bearish, but there's always the chance that it's a fake out, right? There's what I like to say is that you are, in this case, your opponent is on offense, but pinned deep in its own territory. Harder to move the ball across midfield, let alone into the end zone. You have the chance to pick off the ball, stuff the quarterback on downs, or stuff the running back and take over on downs. So there's, whether it's through a turnover or whether it's through just playing good defense, the reversal risk is higher, and you have the ability to be much closer to the end zone and take possession of the ball. And that's the idea is, whether you're mildly bearish, there's a good chance for you to recover the fumble and put it in the end zone here. But also the same is true if I can find one, a mildly bullish. I don't think we have any because this rally is so advanced.
Yeah. Mildly bullish. There you go.
Some reversal risk. So that means that the market forecast line is somewhere between 20 and 50 and rolling higher.
Got it.
Okay. So all of those then get rolled up into this score, which is again based on, we assign a weighting to each of the factors, aggregate them together, and then we assign a weight to each of the categories, and then come up with a composite positive or negative number, depending upon whether it's been mostly bullish or mostly bearish metrics. And then we plot those on a curve, picking the mean score and the standard deviation around the mean score. We rank these from a percentage basis, and then the ticker tier. So that's how it works. So
okay.
For those of you who have no interest in, just tell me, is it good or bad? Follow level 1 or level 2 stocks would be good. With level 2 maybe having more room to run. Level 1 being more bullish, more momentum, but more risk of the rally being closer to the end than the beginning. Level 2 would be mildly bearish, and or bearish, and level 4 would be the most bearish.
Got it.
And you're going to find that and maybe I can get to this. Let's see if I can do this real quick. Pardon my navigation. So I did the analysis on that particular data set.
Uh-huh.
So I can provide the distribution of ticker tiers. Now you'll find that most will skew in the middle part of the curve, but you'll notice that the market is definitely more bullish than bearish, right?
Okay.
You'll see that
makes sense.
The biggest place is level 2 with 35 out of 100 stocks, give or take. And 18 stocks are in the top quartile. And then these are your bottom quartiles. So the market is definitely leaning in the bullish direction here. And then I did some other analysis just to give you an idea of what's possible. I looked at the basically the current snapshot of money flow.
Mm-hmm.
Most are in that negative 0.1 to 0.1 rate at this point. But obviously, we're tilting much more bullish than bearish right now.
Yeah.
So that's the nice thing about having a much bigger data set than when we're scoring our ETFs. And that's why I think we can get away with a slightly more complicated system. And that's why I decided to use this system mostly for stocks. Bigger lists.
Yeah, more data to slice and dice.
Exactly. You need a bigger data set. I think, if you're just measuring 6 indexes like US NASDAQ, the Dow, SPY, maybe the unweighted S&P 500 and the microcap and the midcap index, and maybe against the ACWI, those are your 6 or 7 indexes. Standard deviation of 7 and putting things into quartiles doesn't make a whole lot of sense to me.
No.
So that's why I think the point system works better for ETFs and for basic market analysis, but this much more robust system for stocks, which is why it's going to be a premium feature.
I like this. I like the depth of it. I also like that you've given people the ability to kind of create their own experience.
Choose their own adventure.
Right. I like that a lot. That's cool that you've included that.
Yep. No question. That's what it needs to be.
Yeah.
You probably didn't see any of what I was doing there with Substack, did you?
I didn't know you were. Yeah.
No. Yeah. I was showing a standard deviation curve of.
Oh no, I didn't.
Different things. Well, you know what? Just subscribe. By the way, this is free for a little while longer. So subscribe to Cheat Sheets at stockcheatsheets.substack.com, and you can get this data set fully, and you can play with the data yourself.
Excellent. I'm excited to go play with it right now.
All right. Well, this is 31 minutes that we can't get back. So let's give our viewers a break. Thanks so much for joining us today.
Mike, thanks for doing this.